money and the markets are always changing. And I know some people only want to make just a little bit of money, right? I just want to make a little bit of money. But the markets don't really care about that. So if you're going to want to make a little bit of money, you might as well push it and try to make as much money as you possibly can, because that's what the competition is trying to do. So that's a big number to a lot of people. So the first million is always the hardest in anything that you typically do. Trading, business, real estate, no matter what, the first million is always the hardest. When it comes to trading, a lot of times, money and markets are a game. Money's always changing, the markets are always changing. And we saw this firsthand when this guy, Helicopter Ben, was throwing out money during the financial crisis. What happened is that the game of money became something totally different than what a lot of you were familiar with. The dollar, holding it, depreciates. And instead of trying to invest it as speculative as you possibly can, as what Wall Street does, when you hold on to money, it's essentially being lit on fire. So, how many people have tried to trade options through technical analysis? Neither really work. The reason why is because options are not a stock or any kind of other instrument. It's a volatility product. And when you try to use technical analysis or fundamental analysis, you're going to get inconsistent results. So let's go, how about buying options? How many people buy options? Good amount. What about selling? Does it work, one or the other? Depends, right? And the reason why it depends is because when you understand the product, and I was speaking with a couple people before the event here, and they just got into options as well. And one of the reasons why they just got right back into options is because they tried it, it was too complicated, and they went back to the easy type of product, Forex or stocks or so forth. Because there is a complication to how options work. But if we could understand how to find the right balance and the right risk, I refer to this as earning the right to take a profit. And when you earn the right to take a profit, it allows you to understand how risk and money work hand in hand to create that. So the first thing is we got to create a framework. It's not a system. You can define it as a system or a setup or whatever you want to categorize it as. But with options, it's all about a framework. And 10 years ago, we didn't have the ability to crunch numbers the way that we are able to now. Everything can be crunched and analyzed in a split second. And that's the edge that a lot of institutions have. Some of the biggest firms that trade options trade them in milliseconds. Now, that's not our game. It's not my game, it's not your game. It's not how we're going to be able to achieve the ultimate goal of being consistent and trying to climb the mountain of growing our accounts. But if we can create consistency and positive outcomes, because we need it as human beings, positive outcomes. And I'll show you why in a second. But if we can create that, we'll feel more comfortable and confident in our ability moving forward. So here's a chart here. This bottom line is the SPY. And the blue line, kind of all over the place, but if you look at the top, it shows about 725% gain. It's a 2-year period, and this is just buying a 50 delta call. The last 2 years of buying 50 delta call. That's 30 days to expiration, and when it expires, you buy another one, and you keep doing that. And what we've done here is we created something, at least consistency in what we're doing. Now, it doesn't mean it's going to be profitable, but we are starting to build a foundation of a framework to create some consistency here. How many people would like that kind of return the last 2 years? So as I get done saying here, the expiration for 30 days, so you're buying SPY, 50 delta call, that's 30 days to expire. I know it's a little technical, and I know we have some newer people here. So what I'm going to do is we're going to write out the notes for this, and you can contact us, and we'll give you that report. You'll be able to go through it a little bit more, because it's Saturday morning, we're in Las Vegas, we got some hungover people, and it's a lot of data here. But what I wanted to show you here is that we're starting to build a framework. We're not using technicals, we're not using fundamentals, we're not using Fibonacci's, we're not doing that. And I'm not saying that's a bad thing, it's just when you're trading an instrument like this, we got to trade it the way that works. So 30 days, we risked on one contract, this is what one contract is, $433, a total return of $3,136 for a 725% overall percentage return. The average return, 35. I think the commissions were like $1. We all know commissions are very rock bottom at this point. All best in all, great opportunities for us to be more active and more engaged. But the win rate, 48%. How many people would be able to survive a coin flip, less than a coin flip, on the next trade, knowing that 48% of the time, you're only going to be right? And this is the problem that a lot of people have when it comes to, especially with options, is trying to create that consistency. The outcome on this 2 years, now it could completely fall apart next 2 years, we don't know that. But if we start to build a framework, we can start to create that consistency that I'm speaking about. At the end of the day here, we have a pretty decent return. But it's the win rate that's the tough part of this. It's hard to digest that. Because mentally, when you have that position on and it goes against you, you're going to be reluctant of wanting to do that. That's our human nature. We're not going to want to get through that pain, that frustration, that heartache. We may have not the right account balance as well. So here's something very similar. This one shows a 1,250% return. Same SPY, 2-year, bottom. But here, what we did is this is skip right to the percentage of wins. 76%. Now, a lot of people will say, don't buy options. I'm not here to tell you one way or the other. What I'll tell you is my belief is that it's a pull and push. Here's why. The last 2 years, if you use the market drift, and when I speak of market drift, what I mean specifically is that how money works in the financial markets, money goes into the financial markets. We look at companies like WeWork and Uber, and all these companies. Uber, first company to ever say, we're never going to make a profit, but we're going to raise money on it. It is ridiculous how much money is out there. But money is flowing into the marketplaces, and there's always that natural drift of the markets going higher, and this benefits from that. But here, we create a framework, and what did we do differently here? We did the same thing here. We built out our framework, but what did we do here? We put another thing in there. Gains above 50%. So we didn't let our winners ride. Because again, options are volatility products. You cannot know when something's going to continue to go higher. And especially when you're buying options, there's a thing called time decay. So you have one day, you may be up 100%, but then the next day, it just sits there. Well, what you had yesterday isn't the same that you have the next day, because now you have time decay kicking in, and it eats away at those profits. Now you're concerned, and you're like, well, maybe I'll stop out here. Well, then the next day it may go higher, and then it's... options are volatility products. They are inconsistent on what they do. But if we build out the framework here, we can start to create some consistency, right? Gains above 50%. What about if we closed and then rolled 20 days? So what this means after open is that 30 days to expiration, we buy that contract. It's open 20 days, so 10 days to expiration, and these are trading days, not normal days, but trading days. And then we roll it again. So we don't let it expire, we just roll it 10 days before. And here, we create a higher win rate. And it's not always going to be like this, where it's a higher win rate, and we're going to make that type of return. But what I wanted to show you with here is that buying options isn't the bugaboo or the thing that you shouldn't be doing. every opportunity is equal in the options market. It's understanding when markets and money changes. So let's look at this chart here. The blue line is an option strategy. And the other line is just owning SPY. So what this means here is that if you were passive during this time, 2 years again, this is all 2 years, if you're just passive and you just like, hey, I'm just letting the market do a passive investor approach, that's your return afterwards. And if you were active with options, you had all that volatility, and that was what you were able, right here, to eke out. That is essentially alpha. That is extra alpha. That is better returns, but is that spike down there worth it? Are you going to be able to work through that? It's a tough one. I mean, we all have those down points where we think, man, are we going to stay on this road here? Is it different now? Is the game changed? I mean, we never know. But that's a tough one to swallow. So this one was selling a put. This is a popular strategy that you may have heard of. This is selling a put here, 45 days to expiration. And the win rate here, so many people talk about the win rate. Man, I just want an 80% win rate. Okay. You can have a high win rate. But is that volatility something that you want to deal with? Because here, right here is an 82% win rate. That's pretty good. If I said I had 82% win rate, I can go out and raise money. I can go find investors and say, hey, look, you want to invest into my hedge fund? But is the return worth it at this point? In that 2-year period, it's tough to say, hey, look, this is the only thing that you should be doing, is selling 45-day puts on the SPY. What happens if we start to create a better framework here? This created a little bit better return, but the call rolling approach still outperformed the SPY. And what I changed differently here was, again, just gains above 50%. And the only difference on this one was, instead of being open for 20 days, this was open for 21 days, but it was a longer 45-day cycle, so it's right in the halfway mark. And then again, the trade was open immediately. But if we know our numbers, again, we can create that consistency, and we also create that conviction. And there's a reason why I only use the SPY. It's got 500 stocks in it. You don't have earnings risk. How many people have been burnt by earnings? Yeah, me too. Don't trade them. It's a coin flip. There's no edge. You get ones that like, oh my God, they move two sigma moves, and then the other ones just burn you out. It's frustration because you don't know the numbers. If you knew the numbers on earnings, if you traded earnings, it's a coin flip. So when we know our numbers, it's going to help us, all of us, understand the consistency and have conviction to be able to ultimately continue to grow our account. And our goal is not just to make $1 million. It's to make as much money as we possibly can. That's where I first started. The one thing that I took out of that, and a lot of traders didn't understand this at this time, but a lot of these individuals were market makers. They referred to them as traders. They traded, but they were market makers. They were there to take the other side of the order flow. And by doing that, they created a framework on when they got in and also when they got out. So they managed their profits. They managed their expectations. They earned the right to take a profit because they had to take a profit. So these people they're extinct. A lot of them tried to trade on screens, and they didn't have the edge that they had before. And the reason why is because they didn't understand their numbers. It was just they understood what they were doing. We are like them now. We have the ability to understand our numbers and be part of this. The other part of this as well is that it's chaotic, but if you looked around here, We look very similar. We have our own little pit. It's called the trading pit right here. And what we're doing right now is we're not the lone wolf. We're a wolf pack. And what I mean specifically by this is that a lot of you are trying to operate on your own. Trying to operate on a little laptop, behind the office, or in a basement, or in a closet. Independently, we're all trying to do this ourselves. And the reason why is because we think the guy next to us is trying to take our money, right? In a way, we think the guy next to us is the enemy. But these people, they were not the enemy. They were competitive as hell, but they operated in a way to uplift each other. If one guy didn't want to trade with the other guy, you wouldn't do that. Or if one guy was up $1 million and you knew on his ticket, you saw he was up $1 million, you wouldn't say, I'm not going to trade to that guy anymore. You may be jealous, maybe insecure, maybe ticked off that you got a couple of your trades, right? But you're not going to be like, I'm not going to trade with that guy anymore. It was competitive, but it was cooperation as well. And the good thing about what everyone that showed up today here is that we're that. And the one thing I would tell you is that embrace the people next to you. It's tough to do this by yourself. It's tough to go through the swings that I showed you, especially with your money, without somebody next to you that understands. And we have our wives, we have our fiancés, we have our family members. They just don't understand. My family thinks that I trade stocks, or they ask me about mutual funds or things of that sort. They have no interest in options. But the guy next to you does. The woman next to you does. They care. And the good thing about the expo here is that they're bringing all of you guys together. And the one thing I would stress to really hit that $1 million mark is that you guys need each other. We need each other. You can't do it by yourself. One of the reasons why I was not as successful as I was managing money was because I tried to do it myself. We try to do it ourselves because we want to keep all the money to ourselves. But these guys and ladies down there, more gentlemen, weren't worried about, oh my God, this guy's taking my money out of my pocket. It was an abundance of money. And there's more money than ever before, especially back in those days. You got helicopter bed throwing out money, and there's still quantitative easing out there. So it's not that the other guy is trying to take from you. It's all tide. The saying is all rising tide raises all boats. And that's the same thing with everyone here. We're all working at this together. I'm up here and having the opportunity, and I appreciate it, to be able to provide context and information about it, but I'm doing the same thing as well. I want you guys and ladies to become successful. That's why I start out as aggressive as I do. $1 million. Why? Because we need to get there. We can do it. Because we do it as a wolf pack, and it doesn't mean we roam around, but if we have other people that understand, we can do that. Because statistically, you're never going to succeed that way. And it's just numbers. Again, if we know our numbers, we can create consistency. Warren Buffett, Zuckerberg, Bezos, two of them, all three of them billionaires. Did they do it themselves? No. Warren Buffett, one of the greatest investors ever. Did he use all his money? I mean, he had all the knowledge in the world, but you can't do it yourself. It's silly. Zuckerberg had a great Facebook. Did he keep it all to himself? No, he made himself rich and he made other people rich as well. Bezos, same thing. It's not about the next person trying to get one over on you. It's trying to work together. And when you work together, you become better. So I use this thing as kind of a competition, cooperation, so cooperation. And that's what I really want to emphasize, is that you guys coming out, it takes a lot to come out here. It takes a lot to come up and listen to me speak and provide that time, and I appreciate that. If you could surround yourself with people that understand you and want to build you up, this is what's going to help you. This is what's going to get you. Because again, you can know the numbers, but are you going to be able to work through it? This is a group of traders out on the East Coast. I follow them on Instagram, and when I was putting this together, this picture popped up. Their Instagram thing is Investors Live. But Nathan was operating on his own. But what he did was he opened this little office thing and got a couple other traders. And one of the things he said was that this was a game changer for him. Because you guys are, they're working together. They're doing their own thing, but being around other people and having the accountability help them and is continually help them. We just can't do it on our own. We got to run our own race. We got a framework. We can't be the lone wolf, but can we be the leader? Not all of us are leaders. But do we all have the same goal of crossing that line? This guy, Lawrence, ran that Chicago Marathon this year, 2 hours and 5 minutes. No washing break. 26 miles in 2 hours. That's pretty phenomenal. I mean, the amount of training and just God-given ability. I'm never going to be able to do that. But who's that guy? That's me. But I ran it in 3:51. I mean, Lawrence here, 2 hours and 5 minutes. I mean, he probably had breakfast by the time I was crossing and was leaving the restaurant. But we both achieved the same thing. We both crossed that finish line. And that was running your own race. There's people next to me, there's people in front of me, there's people behind me. But we all finished. And running your own race means that you have to run your own race. Capital in our account is similar to oxygen as I was running. If I wanted to go for Lawrence's record and say, I'm going to go all out and I'm all in, I'm going to be out of oxygen on the side, puffing and puffing, trying to figure out how in the heck am I going to finish this. Understanding that, I probably could do it, but I'm going to have to spend my time trying to get oxygen again. And that's the same thing with capital in our trading accounts. If you want to sprint and try to be Lawrence, you can't be that. You have to run your own race. And what that means, essentially, is the position sizing. We all heard about position sizing. I'm not going to beat you over the head about position sizing, but I wanted to frame it in a different way for everyone to understand that capital is oxygen. Now, the caveat is that there's a lot of oxygen in this room. And as I mentioned earlier, there's a lot of money out there as well. There's various ways to get money. Sometimes you got to be creative, other times you have it. But it's a resource. If the CEO, or former CEO of WeWork can get money, anybody can get money. So when we pace our run, or pace a run, similar, it's like managing risk and position size. The other thing as well is today's victory is the past. We understand that we may have consistency, have a positive outcome, we have confidence. But when I was on mile 24, I was thinking to myself, man, if I wanted to run another one of these things, how the heck am I going to do this right now? Because I could barely get to 26. It's a crazy thought, but that's how I thought. That was my mindset. Because once I crossed that line, what's next? A lot of people hold on to that what's next. A lot of people train for the marathon. I didn't train. Surprising. Now, I run every day. I run 8 miles. 50 miles a week. I didn't train for the marathon. I mean, running 26 in one day is pretty crazy. I didn't train. But what I did was I showed up every day. Because I was always about what's next. The marathon is just an example. It's not to boast up and say, hey, I'm a marathoner. It doesn't really matter to me. It was the next challenge. It's what's next. And it's always about the next trade, the next opportunity. When we understand consistency in our framework and those downtimes where we have to work through it, we have to figure out what's next and not hold on to what's yesterday. or what's right now. We got to go impact today. The thing about the pit, the trading pit, is that the one thing that I learned from those gentlemen is that every day was a new day. Every day was a new day and a new opportunity. No matter, and I took tickets for people. I started as a runner, and a runner meant that I was the lowest person on the tadpole. I went into the pits, and people elbowed me. They refused to try to give me tickets. They gave me a hard time. The janitor had more swag than I did. So if I mouthed off to the janitor would say, hey, this guy has got to go. So I was bottom. But I had to go into the pit. So you understood, you start to see people's trading cards and see what they were up and down. Sometimes people are up a lot, sometimes they're down, sometimes they're big swings. But the one thing that they always came back, they came back the next day. And that's always a tough thing to do. But that's only going to be the way that we achieve the ultimate goal of making that $1 million. Is that we have the framework. I let off with a bang. I made the big promise. I said, hey, look, we've got the framework. A lot of you have gone to these other venues and heard different tactics and different opportunities. And some of them are good, if not all of them. I don't know, I haven't heard all of them. But the framework is only part of it. If you go on your own framework and you try to do this by yourself, we've all tried that, and we've failed because we don't have those other people around us. And we also, if we have a victory, we're trying to hold on to that. So, obviously got a little ahead of myself here. But yesterday was yesterday. Today's today, and tomorrow's tomorrow. And we have to break it up in those moments to be able to keep focused on what is important. And when I start off with making $1 million, I want you guys to think bigger. The goal isn't just about trying to make a small little percentage return. Because, as I mentioned in the beginning, it's not about that. If you're going to do it, you might as well go as tough as you can. Because the market doesn't care. It doesn't matter if I just want to make $100,000 just to pay my bills. If you play like that, you're playing on your heels. You're not playing aggressive. And you're not leveraging the opportunities because it's not always going to be where you can buy in a 2-year period on the SPY, the 50 Delta call, and roll it up and make 1,200%. Why? Because markets and money change. So you got to push it. And pushing it is just saying, hey, yesterday was yesterday, today's today, and tomorrow's tomorrow. So to recap, we're on time here. Framework and knowing your numbers creates consistency. I challenge you to go back or even think to yourself, do I know my numbers? Do I know my win rate right now? A lot of you probably don't, and it's not a bad thing. It's a good thing because now we acknowledge that and we can build ourselves up from it. A rising tide lifts all boats. Again, not the lone wolf, become the wolf pack. Set up a little operation. Get someone that you at least can communicate with. There's Skype. I know groups that have Skype people that talk to each other. There's opportunities out there. And race your own race. Again, the framework and knowing your numbers is the most fundamental part. But it's the other two parts that keeps and holds investors down because they're trying to do it themselves or they're not racing their own race. I crossed that line. So did Lawrence. He was faster. I tried, but he won. Doesn't matter. So I appreciate the opportunity for allowing me to speak with you guys and ladies. And that's all I have.